Thank you all so much for joining us tonight. We see a lot of familiar faces and some unfamiliar faces. So thanks for joining us. We'll spend about half of our time, hopefully not much more than that, going through the content that we've prepared, and then we'll leave some time for question and answer at the end. But also, please feel free to, via the chat box, offer any questions as we go along, and we can answer them through the presentation. If it flows with what we're talking about, then if not, we'll answer them at the end.
So thank you again, Trinity Christian School, for making the Zoom available for tonight's webinar. And you know, Renee and I were talking the other day about really what prompted us to want to put this together, and we sort of heard, you know, anecdotally through some connections that we had, that there was a nonprofit that had raised over 100% of what they sort of were expecting to fundraise over the last year. You know, so they got basically double what they were expecting, and so I sort of inquired, you know, curious, you know, how did that happen? And one of the questions that I asked was, you know, did you receive a lot of gifts of sort of appreciated securities or grants from donor advised funds? And you know, they said no, not any more than we usually do. And so we thought that was, you know, given sort of the asset levels that we are currently seeing, we thought that was a little bit surprising. So we thought it might make sense to put a little, you know, presentation together to talk about tax efficient giving.
And so we'll roughly follow this agenda that we have here. We just a quick background on our firm for those who are not already clients of ours. We're advisors at Professional Financial Solutions, a fee-only financial planning and wealth management firm. We've been in business since 1997. Our current president was one of the founders of the firm, and we're located in Fairfax. We're all certified financial planners among the advisors here. And we provide retirement planning, financial planning, as well as investment management and ongoing financial advising. So just a little bit of background on us. So today, Rob's going to start us off with just a general question on why we should give. Obviously, we presume that this is an important issue to you since you all are tuning in tonight, but just some thought-provoking stuff that he's read recently.
Yeah, so this is a book that was written by Notre Dame professor Christian Smith and a PhD candidate Hillary Davidson, and they really looked into, you know, what is generosity and sort of the idea around the benefits that come from giving, right? And they basically found 9 causations. You know, we sort of talked about them in our little intro that got sent out, but essentially, you know, in their book they've suggested that you know, generous folks typically have fewer illnesses, they have in injuries, they live with a greater sense of sort of purpose in life, and they experience sort of less depression. Some other things in addition to that, you know, they see sort of the world as a place of abundance, if you will. And so, you know, those sorts of things, as we think about, you know, why we would want to give, in addition to what we typically hear when someone comes in and says, you know, I've been giving to, you know, my church, or I've been giving to my school. These are sort of the underlying factors as to what people have found when it comes to giving, that really motivates them to do so.
And I was explaining this to my husband, who was good enough to listen to my practice round last night, and he said, so you're just saying that we should give because it's good for ourselves. Obviously not, you know, giving it benefits our community and our society at large. From our perspective, there are 3 main entities involved in charitable giving. There's the donor, there's the charity, and of course, from our perspective as financial advisors, there's the IRS. And we were motivated to do this presentation because we want to make sure that when our clients or friends are giving, that all of the benefit is going to the donor and to the charity, not necessarily to the IRS. And there are some strategies that help that to come to fruition. Which reminds me.
Did you guys ever hear about, what do the IRS, a mugger, and your kids all have in common? Does anybody know? Well, they all take your money.
So we
want the benefits to go to you, and we want the benefits to go to the charity. We are okay at times with making the IRS sort of the bad guy.
So we will spend most of our presentation today talking about this question of how should I give. So obviously the default tends to be giving in cash, but there are a number of other ways to give that, depending on your financial situation, might be advantageous to you. So we'll talk about giving taxable investments directly to charity, using donor advised funds, giving qualified charitable distributions from your IRA, and also using bequests or naming a charity as beneficiary as a way to give. Other less frequently used means of giving include private foundations or establishing charitable remainder trusts. That's going to be beyond the scope of our talk for today. The expense for maintaining these types of entities usually necessitates a very high level of giving. And for our client base, for most people, that's not necessary to really achieve their goals in terms of giving and doing it in a tax efficient way. So just as an outline on when these types of strategies might be appropriate or most common. So it's not that we're necessarily seeing these 5 options as equally viable at all points during your life. The qualified charitable distributions, for instance, is only available over the age of 70 and a half. So over the age of 70 and a half, you're generally looking at either doing qualified charitable distributions from your IRA or giving cash potentially. Under the age of 70 and a half, usually the decisions are between giving cash versus taxable investments or a donor advised fund. And we'll go into detail on all of these options. As we note at the bottom, making bequests to a charity or naming a charity as beneficiary can be done at any time, but it might be more appropriate later in life. The reason being, certainly if you're married or you have children, you have dependents that might need your assets. If something happened to you, you generally want to make sure that they're taken care of. When you're younger, once you get more into retirement and are more confident that you have more than enough assets to last through your life expectancy, that your spouse and your children are already well taken care of, then that might be a good time to think about including a charity in your will or naming a charity as beneficiary. But again, we'll talk about that in detail in a bit here. So cash is the default, obviously, and the benefits of giving cash to charity. For one thing, you can, if you're already itemizing deductions on your taxes, this can increase your itemized deductions. A recent option is taking an above the line deduction if you're not itemizing, if you're taking a standard deduction. Congress just started this new deduction in 2020, in part, I think, in response to the pandemic, and it's just for up to $300 of giving. So if you take the standard deduction, you can deduct at least $300 of giving done in cash. And at the end of 2020, Congress doubled this for folks who are married filing jointly on their taxes. It has not been extended beyond 2021 at this point, but we expect that we might see that from Congress in the future, because certainly it makes sense from the standpoint of the government to incentivize giving that's good for our society. So the other thing about giving in cash, and this is applicable to some of the other giving vehicles as well, especially since the 2018 tax law, you might have heard about the strategy of bunching charitable giving and taking the standard deduction in off years. So what that means basically is that, say, for instance, you give $10,000 of to charity in a normal tax year. But given your mortgage interest and the amount you pay in taxes, maybe that doesn't push you above the level of the standard deduction, so you wouldn't itemize. But if, for instance, you give 2 years worth of charitable giving and you give 20,000 in one tax year, that would cause you to itemize, and so there would be tax benefits to that level of giving. And then you can take the standard deduction the next year and just get in the habit of doing your charitable giving once every 2 or 3 years, depending on your situation. So that's possible with cash. It's also possible with some of the other vehicles, but we wanted to mention that.
Taxable investments, one of this was sort of what prompted the putting the webinar together. How many taxable investments of appreciated securities were nonprofits receiving or are receiving currently? The benefits of that are, as you have investment gains in your taxable investments, you can avoid paying capital gains on those appreciated securities.
And sorry, just to interject here. So when we say taxable investments, again, for those, we're trying not to use too much jargon. So we're talking here about, say, stocks or mutual funds that were predominantly invested in stocks, most likely, that would have a lot of capital gains because you bought them for one price and now it's worth quite a lot more. So
no, absolutely. And so essentially it can be a good way to diversify out of an investment that you may have big gains in. Say you bought something many years ago. We have a client that bought Bristol Myers Squibb in 1954, I think, and they still have it in their portfolio. It represents a significant portion of their portfolio. It is going to cost a lot of money to sell that Bristol Myers Squibb and diversify out of it. So can it be used as an asset to be given to a charity if there's charitable inclination? Yes, and it can help in the goal of diversifying that portion of their portfolio. So that is a nice sort of strategy or method that we have been able to utilize over time. Some other thoughts about taxable investments. The fair market value of security is applied towards the itemized deduction. So you bought it for $10,000, it's worth $100,000. You donate $100,000, it's the $100,000 that you're able to utilize as the value of the gift that is made to the charity. Additionally, we get to avoid the complication and cost of having a separate account for the charitable giving. That would be if you have donations that are being made to, say, a 1 or 2 charities. One of the things that we have done with taxable investments and giving of appreciated securities is you can donate them directly to the nonprofit as long as the nonprofit has the ability to receive those assets. Some nonprofits we've come to realize aren't well equipped to receive a gift of an appreciated security. They just aren't, and so we can work around that. But it's nice when the nonprofit can do that because, again, as we said, it avoids the complication and cost of having a separate account for charitable giving, meaning a donor advised fund, which there are additional costs associated with that. And
I think here in Northern Virginia, certainly we've found that the majority of nonprofits that our clients want to give to are able to accept that. So, we have one client who gives predominantly to their church every year. And so they have, in the last several years, just gifted mutual funds that had significant gains directly to the church. In another case, a client really motivated during the pandemic to help with feeding the hungry, gave to a couple of different charities in Arlington, Virginia. And again, if you're looking at national charities, they certainly have the ability to accept appreciated securities like that. But even on a more local level, we're seeing that, most kind of sophisticated charities are able to do that. And so that is, as Rob said, an easier way, one fewer account, so you avoid the complication and cost of having a separate account. If you're primarily giving to one or two charities, then that might make sense. However, if you are giving to a large number of charities, or there are a few other considerations, you might want to establish a donor advised fund. So a donor advised fund would be a separate account specifically for the purpose of charitable giving. And in fact, once you gift the securities to a donor advised fund, you no longer actually own those securities. You are then just advising the donor advised fund on where you want that money to be distributed in terms of giving to charity. Of course, they wouldn't remain in business for very long if they were in the habit of denying who you wanted to give your money to, provided it's a 501c3. But so the pros and cons of using a donor advised fund as compared to directly giving taxable assets. Pros, it has all the same advantages as gifting appreciated securities. So, the fair market value of that asset can be used in your itemized deductions. You avoid capital gains tax because, just like with the taxable investments, you gift those investments to the charity is tax exempt. So when they sell, they're not paying capital gains the way you would. So you have all those same advantages. It's a little bit easier if the bunching strategy that we described a couple of slides back when we were talking about cash, if that makes sense, given your situation, to bunch more than 1 year of giving in order to capitalize on higher itemized deductions and then take the standard deduction for a year or two. If that makes sense for you, this is a little bit easier logistically with a donor advised fund, because you could give 1 or 2 or 3 years worth of giving to the donor advised fund at one time, but you can spread out the distribution of assets to charities over that whole time period. You can establish monthly gifts to charity, or they generally have pretty user-friendly websites that you can distribute the assets when you want to give to the charities. So there's 2 separate steps of giving the assets to the donor advised fund and then giving from the donor advised fund to charity. Another advantage is in terms of tax reporting, you get one statement rather than if you give to 10 different charities, in January, you're going to get 10 different statements. With the donor advised fund, you just get one. You can also continue investing. So once you gift to the donor advised fund, you could hold on to the assets that you had transferred into it and continue to let them grow. You could sell and invest in other assets. In our experience, most of our clients tend to gift just the amount that they're giving in a year or two. But we do have some clients, one I know that has given about 60,000 to the donor advised fund, but only distributed about 30,000 over the last few years, and is letting the rest continue to grow before giving to charity. So that is an option as well. And just like as we'll talk about with IRAs, you can also give anonymously. So if privacy is very important to you, and depending on how big or how personal the charity is, that could be an advantage as well.
Yeah, the anonymous piece is nice. If you say you work at, you're working as a volunteer at a nonprofit and you just don't, it's a small nonprofit and everyone knows who everyone is, but you really want to, be able to give in a substantial way and not necessarily, like Renee said, let people know exactly how much, you're able to give. It might be a nice way to do that. And it's very simple in a donor advised fund.
So the main drawback is that you do have to establish this separate account. There are fees involved. They're not very significant, but they are something to consider. So some of the big ones, Schwab, Fidelity, Vanguard, the fees are about 0.6% of the balance per year. So if, for instance, you have about 20,000 in the fund, that would be about $120 per year. So it's certainly not bad for the service that they're providing, but it is something to consider, especially if you don't do a level of giving quite as significant as that. There are also minimum contribution levels. So this can be $5,000, $10,000. In the case of Vanguard, I think it's $25,000. So Just depends on which donor advised fund you use, but there are minimum contribution levels and minimum distribution levels. So usually you have to give at least $250 or $500 to a charity at a minimum. So.
Any questions so far as we have gone through? What questions do we have? The chat box, if anybody's got any, you can certainly enter them there.
And as we said, this donor advised fund is what we've talked about so far would be the ones that we would generally recommend during your working years. Once you hit or earlier in retirement in your 60s, for instance, we have some clients who have donated taxable investments during that phase of life. Once you hit 70 and a half, and certainly once you hit 72, generally the qualified charitable distributions from the IRAs are going to be the most advantageous. So in the absence of questions, we'll talk about those. Get your questions ready for the end. We need at least one good one. Before we let you go, we'll stare you down. So qualified charitable distributions from IRAs. Again, this is only applicable to those over age 70 and a half. You can distribute from your IRAs to charity up to $100,000 per year. So it's not subject to the same limitations as charitable giving during your lifetime. And I just realized we forgot to talk about that. But so for the donor advised fund for gifting and for gifting taxable investments, you are limited to gifting up to 30% of your adjusted gross income. And obviously that's a pretty big number, but if you're talking about bunching more than one charitable gift, or if it is someone who's retired and so their income has dropped, or might be very low depending on the distribution of their assets, that can be something to consider. By contrast, again, the qualified charitable distribution is limited to 100,000, and that's regardless of your income level. Thank you. We got a couple questions, and should we pause? We should pause for our questions.
Get a question. Here we go.
All right. So one question on qualified charitable distributions from IRAs. As for the age 70 and a half or age 72 years, if you're married, is it the older spouse or the younger spouse whose age drives the decision about donor advised fund versus qualified charitable distribution from IRA? That is a great question. So the age 70 and a half or age 72 pertains to the owner of the IRA. So you are required to begin taking minimum distributions from your IRA at age 72. That's age 72 for the account owner of that IRA. And you can make qualified charitable distributions from that IRA when that person is age 70 and a half. So as for the decision between the donor advised fund and the qualified charitable distribution, generally I would say whoever turns 72 first, at that point, you're going to switch to qualified charitable distributions, because we didn't talk about this yet, but the qualified charitable distributions can count towards your requirement for your RMD, your required minimum distribution, but completely avoids ordinary income tax. So, for instance, depending on the size of your IRA, when you turn 72, maybe the IRS requires that you take $20,000 out of your IRA. Well, you decide to give $5,000 directly to charity from your IRA, then you only have to take out and get taxed on $15,000 instead of $20,000. Obviously, when the numbers are bigger, then it makes an even bigger difference. But so I would say whenever the older spouse hits age 72 and is subject to RMDs, then for sure you would want to do qualified charitable distributions. That time frame between age 70 and a half and age 72 is a little bit murky. I would say it really depends on your situation. For instance, whether you're already itemizing based on your mortgage interest and taxes, which is going to make the most sense, and what's the distribution of your taxable assets versus the amount that you have saved in retirement accounts. If you're going to just get crushed in taxes once you hit RMD age, then in all likelihood, it might make sense to start the qualified charitable distributions as early as possible to kind of whittle down the level of that IRA. Also, there's some estate planning considerations with donating from the IRA as compared with taxable assets. We mentioned that here.
Yeah.
Benefits for your heirs. So as you may be familiar with, the tax law that was passed in 2020, the Secure Act, pre-pandemic, changed the rules for inherited IRA accounts.
Mm-hmm.
So beneficiaries need to take all of the money out of inherited IRAs within 10 years for anybody who passed away after the Secure Act was passed. So this really changes the value of different accounts for one's heirs, with IRAs kind of being bottom of the barrel, because your heirs will have to take that out within 10 years. All of that money will come to them as ordinary income. By contrast, taxable account assets, for instance, your heirs will get a full step up in basis at your date of death. And so if they sold everything the next day, they would owe no taxes on that inheritance. And Roths, obviously that's a great vehicle for passing along to your heirs as well. So that being said, using the IRA for your charitable giving means that you are taking money out of those assets, which are not as tax favorable for your heirs, rather than taking it out of your cash or your taxable investments, which will be very beneficial for your heirs to inherit. Oh, you guys are on fire now. We've got some more questions. This is
How
great.
do you find info on how much of your donation will actually go to those who need it, as opposed to overhead, salaries, and staff, etc.? Yeah, I mean, that's a good question. One of the places to look is, GuideStar provides financials for all of the nonprofits that are out there. That's a website that's free. You can, get access to that and look to see, right, how much is going to the actual, work that the nonprofit is in the mission of accomplishing. That's one place. I don't know, Renee, if you had any other thoughts about how to determine how much is going to. I mean, they give ratings as far as how efficient the nonprofit operation is. There are other organizations that are out there, depending on where you're looking, that also do this sort of work and rate different nonprofits. I won't go into specifics because they're sort of more specific to a particular area of a nonprofit, but those do exist if you're looking.
So
well.
GuideStar
is sort of the spot that I would start.
Yeah,
for sure.
We also had a question: does it make sense to donate IRA money to the donor advised fund? I think not, and I'm not even sure that that's allowed. We would have to look into that, but I think not. I don't think there would be any additional tax advantage to doing that.
Right.
Would qualified charitable distribution rules also apply to tax sheltered annuities like 403Bs? Thank you. No, it does not. It has to be from IRA. So that's a really good question. If you have a 403B, certainly you can move it into a rollover IRA and then you could do it, but you couldn't do it directly from a 403B or a 401k. So this is just a question about RMDs. So required minimum distributions now start at age 72. That was again a change with the Secure Act a couple years back. It was previously age 70 and a half. And so the way that that's calculated is whatever your year-end balance, so December 31st from the previous calendar year, the balance of your IRA on that date is divided by a life expectancy factor. And these are, you can Google it. It's a set table. It's called the Uniform Lifetime Table that the IRS publishes. And so you look up the life expectancy factor for your age in that year. So for instance, if you had a required minimum distribution in 2021, and you were turning age 75 in 2021, you would take your December 31st, 2020 balance and divide it by the life expectancy factor, and that would be your required minimum distribution for that year.
And if we want to stay, it's actually changing next year.
There-
A little bit. It's just going to affect it a tiny bit, but the table is actually changing a little bit based on the required minimum distribution age being bumped up.
Yeah, so the IRS is going to expect that people live longer,
Yes.
basically, which is a good thing, certainly in terms of getting crushed on taxes, hopefully a little bit less. Very good question. Are there any maximums or minimum requirements on what you give as part of an RMD? No, there are not. And in fact, logistically, at least from our perspective, qualified charitable distributions from IRAs are extremely easy. We have some clients who give us a list of like 10 or 12 different charities, and with amounts ranging from $100 to thousands of dollars. And it's fine. I mean, we say that. Yeah. Our clients know Megan handles it. So we say it's fine, and she does all the work, but it's actually not a cumbersome process. And basically what happens is we fill out some forms, you submit that to, in our case, TD Ameritrade, or, you know, for somebody else, whatever brokerage it holds the IRA. And then they distribute checks basically right to the charity. And so the advantage there is too, you know, again, if you think about what we were discussing in terms of taxable investments versus a donor advised fund, when you're doing qualified charitable distributions, you don't need any level of sophistication on the part of the charity to accept it, because it basically just comes to them as a check that they can cash. So that's great. And from our perspective, there's no problem. If you want to give us a list of 10 charities and you're just giving $100 to each one, that's totally fine. And it's still to your advantage to do it through the IRA instead of you writing them a check. And there's no limit as far as what percentage of your RMD. You know, it could be 1% of your RMD, it could be more than your RMD, because as I mentioned, the limit is 100,000, and for most people, your RMD is going to be less than 100,000. Oh, yes, great. Thank you.
GuideStar.org.
GuideStar.org.
Thank you.
That's great.
Charity Navigator is another one for sure. Yep. Thank you.
All right, cool. Thanks, guys. That's more fun.
Thank you.
Okay. So we'll get back to the presentation for a few minutes. We've talked about some of this, but please keep the questions coming if you have them. So we talked about avoiding ordinary income tax, which again, here, just a financial planning basic observation for those who are less familiar. When we talk about taxable investments, if you were to sell those, you would owe just capital gains tax on the portion of the investment that had grown from when you purchased it. For the IRAs, as you probably know or recall, that money was invested into the IRA pre-tax, and so you've never paid taxes on it. So when you withdraw it, 100% of your withdrawal, unless you made non-deductible contributions, right. For most people, 100% of your withdrawal will be taxed at ordinary income tax rates, which is higher than a capital gains tax rate. So most people pay 15% for capital gains. Your ordinary income tax rate might be 22%, 24% or higher. So it's really beneficial to avoid that ordinary income tax in particular. As we mentioned with the donor advised fund, also with the qualified charitable distribution, they can be given anonymously. From our perspective, the form at TD Ameritrade, you literally just check a box, and it's very simple to do that. So one thing we did want to note, and our clients who have done qualified charitable distributions hopefully are aware of this already. But there is one little hiccup if you're not aware of it. You do need to communicate to your tax preparer when you've given assets through qualified charitable distributions, because the 1099-R that you will get in January or February that reports distributions from your IRA will just report the gross amount distributed, including the money that went to charity, and which you should not be taxed on. So you have to inform the tax preparer and work with them and show them records of, yes, my required minimum distribution was 20,000. 20,000 came out of the account, but actually 5,000 of it went to charity. So I should only be taxed on 15,000. This is a little, I hope that they will alter this in future years, but so far that is how it's recorded on the tax forms.
So we talked a little bit earlier about bequesting and naming a charity as a beneficiary. One of the ways that I sort of initially learned about this was, you know, sometimes you have a child named Charity, right? And so, you know, say you've got 3 kids. Well, if you're really charitably inclined, you name, you know, your 4th child Charity, sometimes in a very simple way to you know, benefit a charity as you're doing your sort of estate planning. But as we illustrate, you know, you can include charity in a will or a trust, or as a beneficiary of a retirement, investment, or bank account. So some of the, you know, the investment accounts that we have for clients are known as transfer on death, or TOD accounts. And if you wanted to name a charity in there as a beneficiary of that, or a portion of that account, you could do that. It's a really easy way to do that. Secondly, you know, we like to be strategic about sort of the types of assets that we are giving to charity versus family and friends based on the tax treatment. And sort of one of the examples that you know, we have from experience is, you know, we've got a client who is she's continuing to work. She is 76 years old, I believe. She really likes the work that she does. Actually, the work that she does benefits some charities and advocates for different purposes. She's got 1 adult child who's going to inherit, you know, a nice tidy sum of money, and there are no grandchildren. And so what she has done is she took her IRA and she split it 3 ways. One of those new IRA accounts is going to go directly to one of the organizations that she supports. She's going to do this because she wants them to have resources to be able to carry on the work upon her passing. Additionally, she has also utilized, because she is working and doesn't have the need for the assets, she's sort of, you know, basically financially independent. She's using her qualified charitable distributions to do something that we think is pretty neat. When she was younger and her daughter was going to school, she went to a private school, and that private school gave her substantial financial aid to make it work for that family. And so now she's in a position where she has resources, and she's gone back and she's now made, I think, 3 qualified charitable distributions that have totaled about $100,000 that are now going to that school as a sort of a thank you for the, you know, the investment that they made in her daughter, however, 30 years ago. So that's pretty neat. The reason why it works for her is sort of what I described in her situation, but also those are assets that it makes sense to go to a charity rather than her daughter inheriting, because there are tax ramifications to her daughter. So we're happy with, you know, and more importantly, she's happy with that overall planning.
So again, just like as we were talking about on the previous slide, you know, for this client, the portions of her portfolio that she's leaving to charity are the IRAs, because they would come to her daughter as ordinary income, and her daughter would be required to take that money out within 10 years, and it's a significant sum of money, rather than taxable investments or a Roth IRA that has more tax favored status. It's a very sensitive mouse. There we go. How much should I give? Sometimes people ask us this question. Usually they have a pretty good idea of what they'd like to do. But the amount certainly depends on your personal and financial goals, as well as your income and assets. Also, sometimes depends on your stage in life. So we have clients that don't give to charity at all. We have clients that give 10% of their income regularly to charity. It really depends on your goals and what's important to you. From a financial planning perspective, there are benefits to regular charitable giving, such as giving a certain percentage of your income to charity. If you are not living on that portion of your income, then you don't have to replace that portion of income when you retire. That means that you don't have to save quite as much for retirement as someone who is not doing that charitable giving. Similarly, if you have an interruption in income, you lose a job or you have a health issue and for some reason don't have that income coming in, again, you don't have as much income to replace as you would have if you weren't doing the regular charitable giving. But we certainly encounter folks too that are struggling to meet their financial responsibilities, but still feel the pull to give to charity. And I think in that case, it might make sense to just consider that there's possibly different stages of life in which it might be more comfortable to do significant charitable giving. Certainly, we mentioned with respect to naming a charity as beneficiary, that might be something that you want to do when you're at a stage in life where you're very confident that the assets you have are sustainable for your lifetime. And sometimes, certainly, the needs of a charity might influence what a donor does. So we frequently encounter folks who say, my church is doing a building campaign, and so I'd like to make a significant charitable gift beyond the usual amount. And we certainly encourage people to be responsive to the needs of charities as well. Just like our client who gave to the food bank in Arlington during the pandemic. And, was it the best time ever to donate appreciated securities in May of last year, after the market had dipped significantly in March? Not necessarily, but there was a great need. And so we were very happy to facilitate that and really admired her motivation to do so.
Yeah, and in addition to this, as one, Renee sort of mentioned it earlier, we have another case where the client basically has gotten comfortable with where they are, and they've decided over time that they wanted to increase their giving to the number of charities that they are making contributions to, and so that has worked out well. Started out, they gave to like 5 charities, about $5,000 in total, or $6,000 in total. And now 3 years later, they're feeling more comfortable about their financial situation. And I think they're giving to 11 charities, and about $27,000, this year will go out to, to the charity. But it just shows, sort of their approach to giving, which is, I want to be a little bit thoughtful about it and feel comfortable that I have enough to be able to make that work.
And as we mentioned, tax limits on the tax deductibility of gifts may also influence the amount or the timing of gifts. So we mentioned you're limited up to 30% of your adjusted gross income is deductible for gifts to a donor advised fund, or gifts in appreciated assets to a public charity. It could be up to 50% depending on the charity. Certainly you can give more than that. Nobody's going to stop you, but you just can't get the tax deduction for more than that. So especially if you're newly retired, that could be an issue if your income's dropped considerably on your taxes. A lot of these limitations have been loosened a bit during the pandemic, especially for gifts of cash rather than appreciated securities, but that's generally the limit. And we've also had some questions recently about Biden's proposed tax plan. And in general, we don't tend to give advice on tax plans or proposals that haven't come to fruition yet, because we know that Congress could nip that in the bud, or a lot can change between a proposal and a bill being signed into law. So we'll wait and see. But the main issue that would affect charitable giving for some folks under Biden's tax plan is that if you have an income of more than $400,000 a year, your deduction of charitable gifts would be limited to 28% of your income rather than your ordinary income tax rate if you're at a marginal tax bracket above 28%. So you're still getting a pretty significant tax deduction on additional dollars contributed to charity, but not quite to the limit of your tax bracket, which depending on your level of income might be, well above 30%. But we'll wait and see. When should I give? So again, we talked a little bit about this, consider how charitable giving impacts your cash flow at different stages in life. This might look different. We have a client actually who is still in the middle of their career and have their oldest child going off to college. And we proposed gifting taxable investments for their charitable giving to their church, actually as a way of helping their cash flow as they prepare for paying for room and board expenses out of pocket, because they give a considerable amount to their church every month, about $1,000 a month. And we said, well, look, you have these assets with significant capital gains. If you gift the assets and then save the $1,000 a month towards room and board for your son's college, then that could be an easy fix of where to get that money from without incurring significant taxes from selling the taxable investments. So it can be a positive thing for cash flow as well. And then also, we would encourage you to consider how cash flow impacts the charity as well.
Yeah, I mean, I think when if a charity is accustomed to your giving patterns of giving on a monthly basis, and all of a sudden you give them a big lump sum, and this might be nice to let them know, give them a heads up, that it's coming at one fell swoop. Either this year or 2 years worth is coming, at this particular time, so they can budget appropriately for the receipt of those gifts. We'd like to mention that.
And particularly if it's a smaller charity.
Absolutely.
The smaller the charity, the more meaningful any swings in their budget beyond what they're expecting. So we know this, there's a lot of clients on the call, and it's great to see you guys and hear your questions. For those that aren't clients, if you'd like to come in and talk with us, we'd be happy to chat with you. We also have a blog with some good content on it. If you have any questions specifically about charitable giving or generally speaking about financial planning and investments, we'd be happy to talk to you. I think we had a couple more questions in the chat, but then I think you answered yourself, Lynn, so that's cool. If anybody else has questions, we'll unmute everyone now. We appreciate you all joining us tonight, and look forward to seeing many of you over the year ahead.
And we would also say, as we're about to unmute everybody, be in touch with your charities and give to them tax efficiently, because you'll appreciate it and they will too.